So today I'm going to talk about the 3 stocks that I bought, and these 3 stocks I bought not last week, the week before. Now this video should have been out on Friday, but I've just been a bit too busy setting up the new office. So yeah, sorry about that, but in the next kind of 2 weeks we should go back to the whiteboard videos. There's just a couple more bits for me to do, and yeah, we'll get back to them. But for now, it's going to be like this at the moment. So apologies, but not much I can do about it, but it'd be worth it in the long run. But yeah, so it was supposed to be out on Friday, just got a little bit too busy. So sorry about that, but here we go. I'll update you guys, as always, transparency, so you guys know what I've been buying. And yeah, these are the 3 stocks I bought. If you do want to know what I'm buying in real time though, make sure you join the Patreon. That's where I post when I'm buying and selling in real time, as well as that there's 2 exclusive videos a week on there. There's one that's just dropped in the last few hours if you are on the Patreon, so do go check that one out. And there's also a Discord member with 600 members to talk to, and it's only £5 a month as well, so it's probably why it's the highest Patreon subscriber on YouTube. It's not bad if I do say so myself, and I'm trying not to be biased. We'll get stuck into these 3 stocks that I bought. So number 1 is the UK company, S4 Capital. So this company has been in the wars. Well, a lot of growth stocks have been in the wars, but this one in particular in the last couple of months has been especially hurt. It wasn't actually doing too bad. It was on a downtrend, but it was only being on a bit of a downtrend, maybe 30%, maybe up to 40%, where a lot of growth stocks, especially a growth stock that's been on this run, a lot of these growth stocks have been hit 60-70%. So it was kind of holding up a little bit, and then boom, it got hit incredibly hard in the last kind of few weeks. As you can see here, really since February time, you can see the stock is down 45%. And there was a bit of news that came out that the auditors would not sign the accounts off for S4 Capital. That led to them losing 1 billion in market cap. Now it is currently valued at 1.5 billion, but before this it was actually valued at 2.5 billion. So this news took a massive wipe off the market cap, because automatically people thought, well, if the auditors aren't signing off S4 Capital's accounts, there's something fraudulent going on. In the numbers, this affected the revenue. I think it was only by like 1%, affected nothing else financially. I think the cash was correct. There might have been something else that was slightly incorrect because of this, but the numbers were incorrect by like 1%. And S4 Capital openly admitted, we need to do a better job here, but the concerns of, okay, S4 Capital are being fraud in the numbers totally went away. And now the company has gone from pricing in the numbers that S4 Capital have been putting in are fraudulent, and they've all kind of gone away now. It was a bit of an accounting issue, and that's all sorted. It's still valued at the prices it was at when the major concerns were out there that they were fraudulent in the numbers, which is absolutely mental. So I'm currently picking up probably what I call the best UK growth stock. It's my second largest position, that is currently valued at if it was fraud in its numbers still, and it's not. If you look at S4 Capital, they actually came out with a trading update a few weeks ago. The trading update, which was on the 30th of May, was phenomenal. They were very much ahead of market expectations, and this is a marketing company where you've seen so many marketing companies struggle, and as well as being ahead of expectations in an area that's been quite weak at the moment, just in general, to be putting in such good numbers in this time is absolutely amazing. If you look, the reported revenue was up 70% with 40% like for like, and reported gross profit as well was up 64% with 35% like for like. So even with a lot of the issues that's going on in the world right now, this company is smashing the financials, and the share price has no reflection on that at all, and it's crazy. And at the moment, this company is valued at a 2x sales for this company, a company that, like I said just previously, is putting in 70% revenue growth, 64% gross profit growth, and it's valued at 2x sales, which is just unbelievable. The gross margins on this business is 81%, so the path to profitability is very good. Obviously they're reinvesting into the company quite heavily at the moment, but when that kind of levels out, or they stop reinvesting into the company as much, this company is going to be putting very good amounts of profitability in, which is exciting. You look at the future growth, now obviously this is analyst expectations here, but you can see the historic growth is absolutely unbelievable, and even going forward they're going to potentially growing over 30% revenue growth, and it's not going to be too distant in the future before we're seeing good amounts of profit start to come into this company. And when we start talking about if this company can achieve 100 million profit, which they can do, because it's a in the next kind of 12 months, we're expecting them to do nearly 1 billion in revenue, and this company is valued at 1.5 billion, which is insane. But that will put it down to 1 price sales ratio. But at 1 billion, if they start putting even a 10% profit margin in, this is going to look very interesting. Financial health wise, it's still pretty strong as well. It has taken on a little bit of debt for acquisitions, which is absolutely fine because the balance sheet is still incredibly strong, and it is also a founder-led company as well, which is very, very positive to see, and a good sign that they still lead the company and have a good stake in the business as well. So for me, I think this is an absolutely amazing opportunity in the stock market as well. Right now, one of the best UK stocks on sale for sure. So about time I bought some more, so I did, and I bought some S4 Capital. So the second stock on this list is probably my second favorite growth stock, I would say. Obviously I'm a massive DraftKings bull, but I think I would say Hims and Hers is probably my second favorite growth stock that's on the US side of it, just because this company has been absolutely smashing it so much over the next 12 months. Not that that's had any benefit in the share price, even though they keep coming out and bringing, you know, unbelievable earnings out and raising the guidance huge amount, and all that actually leads the share price to do is it has a bumper day when the news comes out, and it just keeps getting dragged down by the market lower and lower, and obviously because the sentiment's really negative to growth stocks at the moment. When the sentiment changes with this stock, whenever that may be, maybe it's in a week, 2 months, a year, 2 years, this will go on a massive run, because this here, I think it's not going to be too hard for this to easily shoot up to $10, and then I think even in the longer term we'll be talking a stock that starts pushing $30-40, and in my opinion this is one of the stocks that I've got penciled in as what can potentially be a multi-bagger for me in the next coming 5-10 years. So yeah, I'm really excited about this one. So Hims and Hers is a telehealth play, and like I said, this company has been absolutely smashing it. They brought Q4 out, they smashed the numbers, they hiked the guidance up, and then I thought, okay, we're not going to see a guidance hike in Q1, and then what did they do? Once again, back-to-back quarters hiking up the guidance, which is great. The new guidance was a massive hike from 378 million to 410 to 425 million. And the losses on the company are shrinking as it moves to profitability. It has fantastic gross margins, and that's how it can move to profitability. You can see here the losses are shrinking as it moves to profitability, and the revenue growth was 93% year over year. Same again, this company is valued at 2 times sales, which is just insanely cheap for a company that has these gross margins of 74%, as well as having a 93% revenue growth, which is fantastic. And when this company came through its SPAC 2 years ago, the company was doing around 82 million. You can see now the company is actually doing 320 million. And by the end of the year, this company, like we said earlier, could be doing potentially 420 million, which is just absolute insane growth over these last few years. This company's been growing fantastically, and it's quite a new company as well. It was only founded, I think, in 2017 or 2018. You can see here, analysts are expecting mass amounts of growth. They are not expecting profitability in the next 2 years. I disagree. I think when the gross margins are like this and the cutting costs, we will see profitability in Hims and Hers in the next 2 years as well, which is great. And financial health wise, it's very good. It's got no debt at all on the balance sheet, and it's sitting on 203 million as well, and it's not burning through that much cash anyway. So even worst case scenario, if it does 63 million in loss, which I think the big days of losing money are going to start shrinking down massively now for Hims and Hers, but it's got a good run rate without having to raise any capital at all, which is great. And as well as that, it is a founder-led company, and once again the founder is one of the biggest shareholders here, a 9.7% ownership, which is great. So yeah, massive fan of Hims and Hers. It's one of the stocks that I've got down as potentially a multi-bagger in the next 5-10 years. So yeah, I'm trying to accumulate shares as much as possible at these sort of prices for this one. And the last stock is Google. So this is a new position for me. I think Google is very good at these sort of valuations. I don't know if I prefer Google, Meta, or PayPal more at these valuations. However, I think all three are fantastic opportunities. Now Google, or Alphabet I should say more often, it does not really have that many dips. Historically, when it does have dips, they always prove to be good buying opportunities in the stock. And at the moment we do have a dip of around 23% on Google, which is normally one of the biggest dips it normally has. It doesn't normally push more than 30%. And I think already it's a cheap valuation at 20 times earnings, and when you consider the moat on this company, the balance sheet, the profit, the growth drivers it has, it's going to be easy for me in the next 5 years. I'm going to double my money in this. I think it's a very safe bet where I can double my money. And the thing as well is, like, what we're seeing with a lot of these big tech companies is they're struggling because the numbers from them aren't that good at the moment. And the thing with Google is that they are actually putting in pretty good numbers at the moment. Sure, the profit is a little bit lower than what's expected as they reinvest into the company slightly. However, when you look at the company from a growth point of view, there's no struggles here for the growth. They're still growing at 23%, and sure, the YouTube side is a little bit slower than what is expected. However, the YouTube growth driver is only just starting, and that has potentially so much room to grow, and I'm sure that will see you bounce back in the next coming few months or quarters. And like I said, you look at the growth point of view, it's got a very good track record, and I think it will carry on growing at good rates, high teens going forward. Financial health wise, it's probably one of the companies with the strongest balance sheets on the stock market. It's only got a slight debt to equity on here, but you could easily play that debt off because it is sitting on 134 billion at the end of the day, and that also gives them a lot of opportunities to use that cash for other things like potentially share buybacks, which is great. So yeah, this is for me one of the companies that I'm trying to build up into quite a big positions, because it's a fantastic, revenue growth, it's got profit, it's got a great balance sheet, it's a cheap valuation at 20 times earnings. It's currently on a dip, and it doesn't normally historically have that many dips. And for me, it's just a very safe company. So yeah, I'm trying to build up a really good position in Google. If I can, Google could easily become a top 3 position. I could easily make Google my biggest position. That's how confident I am on Google. So potentially we'll see what happens. For me to make Google my biggest position, I would have to have Google at these sort of prices for like a year. I don't think that will happen, so I think that's what will stop it from happening. But yeah, this is one of the stocks that I will put more, I'm happy to put more capital into, because when I look at the risk to reward, there's not much, in my opinion, of risk here right now. So yeah, big fan of this one at these sort of valuations. So I hope you enjoyed it. Let me know what stocks you've been buying as always, and I'll catch you on the next video.